I've got a lot of clients in this scenario that they're wanting to buy a property, they've been trying to get into the market, and then they get to a point where they just can't pull the trigger. And now they're seeing rates go up, so they're thinking, maybe we'll just wait a bit longer. What are your thoughts around that? Like, how should they think about the fact that rates are going up, borrowing power is being affected? Is it smart to just sit on the sidelines, or is it just go for it?
The common question that we get asked in our business all the time when we have clients that are considering working with us and they ask that question, is now a good time? I always add to that question as well and ask them, is now a good time for you specifically? Can you comfortably afford this? Is it going to put you under any financial stress? Do you have the buffer to be able to handle the repayments, and also to have a safety buffer, an emergency fund, whatever you want to call it, so that you're not stretched too thin? And if you do have all these things considered, then
Welcome back to the Winner's Playbook. Billy here, and today I'm joined by buyer's agent Kev Tran. There's a lot happening in the Australian property market right now. The RBA lifted the cash rate to 4.1% recently. National home prices rose 0.5% in February and are 9% higher than a year ago. And capital city median values have now pushed above $1 million. At the same time, the CGT discount is back in the conversation. So there's a lot for buyers and investors to unpack. So today we're going to break down what is actually happening on the ground, what it means if you are thinking about buying in 2026. Welcome, Kev.
thanks for having me back on, Billy.
Yeah, and what's going on, mate? We're just talking about all of a sudden down here in Melbourne, the temperature's plummeted to 13 degrees. So we're cocking our first wintry blast. What's the latest in Sydney? I assume you're in Sydney at the moment.
Yeah, in Sydney. Today's still a relatively nice day, but I think we're supposed to be in for some rain. But overall, I can't complain. Much better than you guys, as usual.
Complain. Yeah, and have you been doing much travel? Like, because I know you guys buy all around Australia. Are you personally doing much travel at the moment, or you got other people doing the work on the ground?
Yeah, got the team. They're spread across different markets. So we've got a couple guys in Melbourne, Scotty's in Adelaide, Joel's in the Gold Coast. So we've got a few of the guys spread around, and they'll do a bit of travel as well. But yeah, not so much for myself at the moment. A few things we're working on holistically with the business, and strategizing with clients and everything, and especially on the research piece. There's a lot of moving parts, which we'll get into today. But I think unpacking it all is going to be really key for your listeners. And basically, we were talking about all those issues that you mentioned now with interest rates and tax reform on the horizon. There's so many things. Obviously, we're in an inflationary environment too, and as many of your listeners and clients already know, in these sort of environments, asset prices typically go up, and obviously your money's not being invested wisely. It's losing value, right? So at the same time, we can't blindly invest because we're not in the COVID period anymore, and markets are moving all over the place. So really key to move forward with a bit of clarity, which we'll go into today.
Yeah, and I see, like, obviously we do a lot of work around the stock market, and you're purely property focused, but I feel like there's some parallels in the sense that over the last 12 months in the stock market, there's a huge dispersion of assets that performed well and assets that did not perform well. Like, if I'm sitting in front of a client and we're looking at the last 12 months, they might have a managed fund that's done negative 20%, and then they might have another fund with a different strategy that's done plus 20% over the last 12 months. So it seems like in property, there's a bit more of that going on as well. Like, different markets are performing in really different ways. Is that what you're saying, or not?
Yeah, absolutely. And even within those markets, different price points are moving in different different percentage points and all this stuff as well. So, to kind of add to more confusion, being real granular with your research and understanding, the types of properties and budgets you're going after are key. And even within regions, on a suburb basis, things can vary even further. So, these are all important things to look at for sure.
Okay, so what are you seeing on the ground right now? Like, what kind of property market are we in? Because, I mean, I've heard from clients if they're in Brisbane, for example, a huge amount of competition, not a lot of stock. But certainly there's parts of Melbourne and Victoria where it's completely different story. So what does it feel like now, especially in the last 2 months with rate rises back on the cards?
Yeah, I guess what's going to be helpful, what I want to do as well, we'll get into specific market differences and disparity there and all that stuff. But even to set the stage without getting into too much, because I think it may even cause a bit more analysis paralysis for some people, is just to take a step back. Obviously, there's a lot of things happening locally and globally at the moment. We touched on a few things, even I guess we haven't touched on like a war in the Middle East, rising oil and energy costs, and all these things. It plays a big part into sentiment, and they're also real things, like obviously, with every interest rate rise, rising inflationary costs, like household budgets are stretched, borrowing capacity decreases. So, we want to factor that in. But what we should also remember is if we take a step back, uh, these don't have a direct impact on the structural supply and demand imbalance we have in the country, right? If you look at 1, 5-year, and even 10-year uh, differences, we're probably about 15 to 20% undersupplied with total listings, right? And on the rental side, we're probably even further, probably about 20% um, below, the 10-year averages and the pre-COVID levels as well. So just factoring in that, we're undersupplied. The demand aspect, with immigration, we're not building enough houses as it is, right? So with these in mind, um, what we need to remember then is, okay, cool. Certain markets, this pressure is even further. So the headline, that you mentioned there, about 9-10% growth in the last 12 months to February, but markets are moving in different levels. So you've got Perth, Darwin, Brisbane, Adelaide, all double-digit growth in the last 12 months. Perth at 22% growth, which is crazy.
Right.
People have been talking about Perth being done for the last few years now, but fundamentals are there. And Brisbane, 17%, Darwin, 19% growth, and Adelaide still sitting around 11% growth there. Where things are a little bit weaker, you've got Canberra, Sydney and Hobart sitting around 6-7% in the last 12 months. And then Melbourne still trailing around 4.7% growth, 1% lower than its COVID boom peak around March 2022. However, again, in saying that, within these markets, because you're not buying in the whole city, right? You're buying in a particular suburb. You've got a large disparity as well. Melbourne, great example. If you go, this is all around the city. It's not in any particular region. If you go west or south or east, whatever. One example is Sunshine West, at 14% growth in the last 12 months, versus somewhere in a ring of Q, down about 6%. All right, so this probably leads into nicely what we're seeing within certain markets, and this is consistent across all markets in Australia, is that the lower quartile it has been performing much better than the higher quartile, the upper quartile. So the more affordable markets within each region are performing better, which makes a lot of sense if you factor in since May 2022 onwards, we've had the aggressive rate hikes. We had a couple of decreases then, but now we're seeming to be on a rate hike cycle again. So when that happens, every 25 basis point or 0.25% interest rate increase, we lose about 2 to 3% borrowing capacity. So if rates go up 1%, it's about a 10% decrease in borrowing capacity. So it makes sense that, people are going to be looking toward the lower price markets when rates go up.
Yeah, so you mentioned Kew, which is where I just moved my family to Kew last year. Um, so all those higher end sort of suburbs in Victoria in particular are just have gone nowhere for a number of years, right? Um, And it's just about like as you say, interest rates have gone up. So if you go back a while, a high income earning professional couple might have played in that space and bought those sorts of properties. But the price points they're at now, if you've got a 6% rate on your loan, they're just not even affordable even at high income levels.
Exactly.
So it's a
Fundamentally, when you look at
sub
how
1 million. So is it like the sub 1 million mark is where most of the growth is occurring over the last 12 months?
yeah, again, it depends on the market that we're looking at. So obviously every market, will have a different price points that we're looking at, but for, in their own respective markets, the lower quartile. So, Perth will be different to Melbourne, for example, and all that stuff. But yeah, that's where we're seeing that shift definitely.
Okay. And so for people who, like, I've got a lot of clients in this scenario, they're wanting to buy a property, they've been trying to get into the market, and then they just, yeah, they get to a point where they just can't pull the trigger. And now they're seeing rates go up. So they're thinking, oh, yeah, maybe we'll just wait a bit longer. What are your thoughts around that? Like, how should they think about the fact that rates are going up, borrowing power is being affected? Um, is it smart to just sit on the sidelines, or should you just go for it?
Yeah, it's a common question that we get asked in our business all the time when we have clients that are considering working with us, and they ask that question. Is now a good time? I always add to that question as well, and ask them, Is now a good time for you specifically? Can you comfortably afford this? Is it going to put you under any financial stress? Do you have the buffer to be able to handle the repayments, and also to have a safety buffer, an emergency fund, whatever you want to call it, so that you're not like stretched too thin. And if you do have all these things considered, then it may make sense. And depending on your objective, whether it's your owner occupied to live in or as an investment, talking about, the initial points before about being in an inflationary environment, if you've got funds sitting there not doing anything properly, then, you're really doing yourself a disservice, especially historically looking at the most aggressive rate hikes we've had in history just a couple of years back. And then, what we're seeing now, markets are still moving, particular markets, of course. Also, a point that I didn't mention earlier when we were talking about, like what we're seeing in certain segments. Another element to why maybe the more affordable markets have been performing better, in addition to affordability with borrowing capacity going down and stuff, is also first home buyer territory in a lot of these markets. So in October last year, the government expanded the incentives they had for the 5% deposit scheme, which basically removed caps on income, and budgets increased as well for eligibility around the country. And well, it's still earlier days, but for the initial reports that I've seen, in the first month that it was introduced, about 1 in 10 purchases nationally involved that scheme, which is right on par with what the government was expecting. So, you've got these demand-driven incentives adding fuel to the fire. We talked about the supply issue already. Nothing's really been done to address the supply, and now with all the pressures as well, with um, energy costs and everything, it's going to have an on-flow effect. There's already reports of tradespeople, building industry. They're reporting the supplies and materials are already costing more, so it's going to be factored in as well. So all these things is what I'm saying. Multiple reasons, but you can see why that affordable segment is seeing more pressure.
Yeah, the construction cost thing is interesting because obviously we saw those skyrocket after the post-COVID period. And yeah, I saw those headlines as well saying, yeah, due to energy costs and fuel costs and supply issues, there could be another 20 or 30% increase in the cost of housing construction. Would you
Yeah,
say? Because I mean, what's it going to cost $1 million to build just a basic family home?
it's mental. So then
So
there's
why
so
would
many
you do that when you can go buy one that's already someone else built 10 years ago and it's selling for 700K?
exactly. So that's another point as well. There's so many factors and metrics that we look at, and in value markets, Melbourne being a really prime example of one that we like. Um, you can buy blocks where if you factor in the land and the build, like you're getting at replacement value of the property. So like you're there's a lot of there are many reasons why, the certain segments in areas that have that supply and demand pressure, solid fundamentals are performing well. But yeah, the side note, like all these, basically every aspect of our life, like if the government actually wanted to help, they would just make taxes more efficient for a lot of these things, especially with building. But probably for another conversation.
Yeah, and you said before replacement cost, so it's like you're almost like getting the land for free. It's like the actual building, like the price you're paying might be basically just the cost of the actual house,
Yeah,
like the
exactly.
cost to build that house.
Yeah, exactly. So if you can buy a block somewhere, you buy a house in a block established, for 700 grand, but that exact house to rebuild it's going to cost you more than 700 or 700 in today's dollars. Yeah, like you said, the land's effectively free. So it if you actually look at it that way, it makes so much sense.
Yeah, and you mentioned government. We are going to talk about them briefly because it's quite significant, right? They're looking at capital gains tax, and I heard rumors of restricting negative gearing, things like that. What's the latest that what have you heard on the grapevine?
Yeah, look, I mean, on our side, we stick to the fundamentals in terms of what we see in terms of the macro economic aspects of the region. Why we like particular areas, why we're investing in them, and then obviously the supply and demand equation, stuff that we know confidently as well. So regardless of what's happening in the tax environment or any other incentives, we look at the other fundamentals, right? Supply and demand. However, like I was saying earlier in the call, the the third aspect, which is a bit harder to measure, is sentiment. Obviously, there is like consumer
Yes.
sentiment reports and all this stuff, but you know, buyer psychology has a massive factor on how people view property markets and all this stuff. So, and that element, when you look at tax, it can either incentivize or disincentivize supply and demand. So, what I can say is, like, if the government is going to be disincentivizing by increasing taxes on exit costs, if someone doesn't really need to sell, why would they?
Yeah.
I would hold on for it a bit longer, potentially leverage your equity there, which doesn't get taxed. There's a lot of ways to move around. Um, there's yeah, there you can add things on on the demand side, like the whole first home owner grants and all that stuff. But if you disincentivize supply, what I can see is it's going to have an adverse effect. It's going to cause prices to go up. Um, and then if there are less rental properties as well in the market, let's say for example, people do sell down. It depends on what the actual um, details are, right? Of any changes they have in the future, whether it's CGD or negative gearing. If they grandfather based on certain, like if you bought before a certain date, where they'll still honor the previous arrangement, then it may incentivize people to sell before a certain date.
Yeah.
And that might increase supply in the short term. But if it's going to disincentivize people to enter the market as investors, we already know that we're 20 to 30% short on rental listings over the long term. What that's going to do is, as we know, less rental supply, rents are going to go up. So that could actually have a serious impact on renters, because even though the government loves to, and it comes from a good place, they want to increase home ownership rates, which makes sense. But people are always going to be renting, circa 30% of
Yes.
the country, whether they're moving or they're in between jobs or they're not in a position to. Could be new migrants coming into the country or moving across other parts of the country, not in a position to buy just yet. So what's going to happen with them? It's going to be harder to save for a deposit to buy a house because your rents are going up. So these aren't really thought out policies, but yeah, I guess time will tell with the budget in May.
Yeah, that's it. Yeah, I'll never understand this like opposition to all landlords because we've all rented before. I'm renting it. Well, we owned our house for 10 years. So we decided to go back to a rent pesting strategy for a few reasons. We're renting. We love to have a good landlord. I mean, why would you? And there's loads of them out there. So I don't understand that at all.
Yeah, because I think as property investors are
To rent, need to rent permanently or temporarily. So if you have nice landlords and good property management, it's a good, everyone wins. So
Exactly. The property investors are just easier to target.
yeah, that's it. That's it. No, it's all about raising some extra taxes, I think, is a large part of it. All right. So yeah, we'll see some changes there. I agree with you. I can't see it's not addressing the underlying problem, right? So they'll tweak a few settings. It might have some impact on the market, but they're still not addressing the underlying issue. So it probably doesn't really change too much around anyone's property investing strategy. And have you seen much of a shift in the last few months in term like when you go out and you're sourcing properties for clients, is the competition still as extreme as it was a few months ago in some areas? Like, are buyers still competing really hard, or is there a bit of a softening there because of these rate hikes?
Look, if you ask the last few months, I'd say it's still as competitive as ever. The last maybe week or two, and again, it's still too short of a time period. I'd love to have a bit more of a sample size, but we are potentially seeing some hesitancy. All right. And I guess historically, anytime there's been a bit of uncertainty, that happens, right? Like, you go back to just some recent examples we talked about with the rate hikes back in May 2022. For the first few months, it was a little bit uncertain, and it was a really good time to be buying. When people got used to it and they realized it's not changing anything, the underlying issue that we talked about, everyone kind of rushed back in. Same thing during COVID. There was probably like a few month period where prices were, they corrected themselves a little bit until they started booming. So yeah, we're ready on our side. As long as everything makes sense, our clients financially and emotionally ready, we find a really good deal, we'll strike. If there are the buyers who were kind of sitting on the fence, we'll take advantage of that. But yeah, it's still too early to see, I think.
Okay, and so what sort of properties make sense at the moment? Like what sort of types of properties and locations are you guys focusing on at the moment?
Yeah, so unless things fundamentally change, we're always going to be um, a house with land established, in a good region, whether it's a capital city or a strong regional market, where we look at local government areas as opposed to just a blanket capital city versus regional. Um, all the reasons we mentioned before, established, you can get something straight away, normally in areas that already have established demand, and you've got a lot of usable data behind that, like how many renters, owner occupiers, and all these things, new supply coming on board, etc. But there is a shift that I'm seeing now versus 1, 2 years ago, which is the real low end of the market, like say sub 550K or 600K. 2 years ago, maybe even a year ago, we were buying comfortably in strong regions, a house. That's getting effectively like impossible now to be buying in a good market without sacrificing the location. So in those markets, what we're seeing now is, or sorry, in strong, like for those 550, 600K budgets, we're seeing a shift to townhouses and like boutique villas and units. So we're not talking about your medium density or high density apartments, but like, your villas, your townhouses, that could be on a lot of two or five, sharing a driveway, something like that. You might even have your own little yard. They're presenting a really good opportunity. So there's a few things you can look at there. You can get Adelaide, Melbourne, um, for those prices we talked about, and better yields too. So really good opportunity.
Yeah, that's something that I've just literally become interested in the last month is those 2 or 3 bed units, older blocks with 4 or 6 or maybe 8 on a block in a really good location. I mean, if you like, say you're a young family or a couple without kids and you want to live in a nice suburb in a capital city, but you're not spending over $1 million, that's what you're looking at, right? Those 2 or 3 bed units, ideally.
Yeah, exactly. I think that's
Yeah.
going to be the theme. I tell clients all the time, like the theme moving forward is going to be where is their value? You know, yields have compressed significantly, so you're not chasing rental returns or yields. They may have to be important factors for your lending requirements, but um, But to your point, like, uh, the attractiveness to young families, downsizers, even students, anyone like that who won't be living in more premium markets, proximity to CBDs, or just in good suburbs where house prices are, way more expensive. That disparity between these type of assets versus houses, that's where you see the value. I can tell you now, like, in Sunshine, in Brimbank, really good. We're talked about Sunshine West having 14% growth for houses the last 12 months. A lot of houses there, 700, 800, 900 grand. You can still get your these, boutique villas or townhouses we're talking about for sub 600K, right? Same thing with certain suburbs in Adelaide. Prospect is one that we're looking at where, it's a really strong suburb itself. Um, Same thing, great opportunities. And then even Geelong, one suburb is Highton, where houses are 1.3 mil. Same thing, you can buy these type of assets for sub 600K. So the value, like you said, is really there.
Yeah, and they don't really build them like that anymore, do they? It's like either a tower or out at like houses on really small blocks all jammed in together. Like they don't really build those 4 unit, 6 unit type developments. Is that right? Or
Yeah, I guess we're seeing less of them. I mean, it makes sense, right? Like if you're going to be with cost of development, you want to be cramming in as much as you can. So moving forward, like you said, the trends are likely, not going to be seeing these types. We're seeing some, even two, two lots. Sorry, two properties on like one lot, which is pretty cool.
okay, and what are some common mistakes that you see? Like this is probably a question you've had many times over the years, or many things like you've seen this a lot. What are the common mistakes that people make when they're going out and buying a property on their own, and too much emotion comes into the transaction or into the decision?
Yeah, like, I think, like, even though houses are becoming really unaffordable, look at what those other options are, like we talked about, whether it's an owner occupier or, you're investing. I really still don't like medium and high density apartments. You know, the, the basically any time that the more neighbors you're sharing, the more walls, more common areas, facilities, pools, lifts, and all that stuff, it just has more liabilities for your body corporate strata to be higher, plus special levies if it's not managed well. And in my experience, especially in Sydney, most aren't managed well, right? So that's a really, really big thing, which can be a real anchor to your wealth creation. You think you're doing a really good job getting onto the market, but um, the latter, sorry, but it can really hurt you. So understand what your options are is where you can potentially avoid making those mistakes. Um, and right now as well, like I said, we're definitely not in a COVID boom period where you can buy anything and expect to grow. You really need to do your due diligence, and don't stretch too thin, especially in a high living cost environment. Make sure you've got those buffers in place because the last thing you want is to pay stamp duty and everything on the way in, and then something happens and then you can't hold it. You've got to sell it. Imagine there's an investment property, you held it for less than 12 months and no CGT discount at all, right? So all these things need to be factored in.
Yes, yeah, agreed. And yeah, I've seen multiple stories with clients over the last year about body corp, growing issue with those costs skyrocketing and eating into your return. Yeah, there's a few nightmare stories. What about in Melbourne? Like, there's pretty well known advice now. Just don't buy, in South Bank CBD, small apartments. There's been no growth there for what, 15 plus years.
Yeah.
Does that ever reach a bottom, or is the problem is they just keep building new towers? Is there value? It's not. Is at some point is there value? I mean, they can't keep dropping in value forever, can they?
I mean, if there was no body corporate issue and it's really managed well, and you're purely looking at the asset from a supply and demand perspective, then you could potentially make the case. But because there's so many liabilities and risks that open up because of the ongoing maintenance concerns with these buildings, um, it just becomes this huge unknown, that could really eat into everything. So Yeah, for me, it's just you go, all right, cool. What's your budget? What are your objectives? All right, cool. These are the better options. Kind of thing. We want to look at how bad things can get on that side, you know?
Yeah, and I guess those buildings keep getting older, right? So more issues emerge. The cost of holding those units keeps rising. And at the end of the day, if you're in a big building there, you've got no land component. Yeah, that's a worry. What's South Bank going to look like in 20 years' time? We're not great.
Yeah, I mean, in order for them to be maintained, it's going to cost a lot of money, right? So, yeah.
That's it. Right. So, and if someone, well, probably last question, unless you built some other notes you want to cover, Kev. If someone is keen to buy, and by the way, I've got a number of clients I've spoken to just in the last month on this. Someone is keen to buy within the next 6 to 12 months. What should they do to prepare for that and put them in a strong position to go and pull the trigger and make a good decision?
Yeah, I think especially in like we keep referring back to it, but the environment that we're in, it's a real negative sentiment, with a valid reason. You know, living costs going up, crisis around the world, energy costs, all these things, interest rates. Um, I think the main thing for every individual that's considering investing or buying property is just to make sure, like we said, you've got those buffers in place. So go speak with a really good broker, understand what is your max budget. It doesn't mean you'll go to that max budget, but you'll know where you can draw the line in terms of what the banks will lend you. Because the banks also factor in a buffer on top of that interest rate. So, like normally it's like a 3% buffer. The interest rate's at 6% now. They're factoring you can afford this when it goes to 9%. The question is going to be, are you comfortable to do that or not? Right. So, know what the banks will lend you to the max, then understand what you're comfortable with personally. So, how I've always done it for myself personally is understand, all right, cool, what are my monthly expenses? And this looks different for everyone. Obviously, if you're a young person living at home, with no real expenses, you can get away with much less of an emergency buffer versus a family with 3 kids in school. So understand what that looks like. Have X amount of months, could be 6 months worth of a buffer. That way, okay, cool. How much can I afford to put into this property for stamp duty, deposit, and all this stuff? And then how much will I have left over at the end? You can be comfortable there, and then also know, all right, cool, on a monthly basis, how much am I my saving after all my expenses to actually like feed into this mortgage, even factoring in rent and stuff. So once you've done all that, you can walk into a deal, or you can start searching confidently without kind of second guessing yourself and then turning on the news and not seeing all this negative stuff and then not taking any action. So that's probably my biggest advice.
Yeah, sound advice, Kev. The other thing that I would add to that is why are you buying this property? Because if it's a pure investment, you have no intention to ever use this property. It's just a pure, I'm doing this for wealth creation and to put myself in a good position in the future. Then you've got all of Australia to choose from. But if there's some other things there, like, hey, I might actually use this property in the future or live in it or rent it to a family member, then you might be more constrained about what locations you're looking at, what sort of property it is. Now, I think that's something a lot of people don't think about, because if they're investing, for example, they'll just think about the areas they know, and they'll be like, "Oh, I should buy there because I know that that's a good area." But the reality is, you've got the whole country to choose from. If you're just making a pure investment decision, yeah. Do
Yeah.
do you have that sort of discussion as well with people?
Yeah, 100%. 100%. Like the objective is really important. And obviously I'm only in the investment space with property. So, if someone's coming to me and they're like, should I do this? Should I do that? You know, if they kind of talk about those things, like you mentioned, where, hey, I might be buying it as an investment, but we may move into it later, or I might have a property for one of my kids because obviously I want them to have a property in certain market. I'm like, that's a valid reason, and that kind of then goes into like a personal reason as well, or lifestyle, which
Lifestyle choice,
yeah,
yeah.
exactly, which is a bit different to just purely getting a return. So, but if it is purely a return, like you said, one big positive that we have nowadays is there's so much data that you can move with conviction in whatever market you go to. And out of all the properties that I own in my portfolio, I've only ever seen one of them physically once, like in person. So
Yeah.
I don't know if maybe they don't exist, but no, it's there's so much out there you can rely on people to to move forward with confidence.
All right, and I think it might be a good place to wind up. Where this is a funny question because I don't know if it's still relevant anymore. But where can people find you if they want to have a chat?
Yeah, so it's on socials, Kev Tran Group. So it's KEVTRAN group. Our website kevtran.com.au. You just find us there, and yeah, we can have a chat.
Awesome. Any plans to start a podcast?
Yes, and definitely going to have you on, Billy. I'd love to invite you on. So yeah, stay tuned. Hopefully the next month or two.
Yeah, that's why I asked the question, just in case it wasn't, you weren't ready to release that information to the public yet.
Yeah, we're going to have a little brand update as well. So I'm excited. I will announce some stuff very soon.
Awesome. Well, thanks to have you on, mate. And we'll just wind up. So the market's still moving, but that does not mean people need to panic or rush. The key is to understand your position, know what type of property actually suits your goals, and buying with a plan instead of just reacting to headlines. If you're thinking about buying this year, reach out and we'll help you work through the next step. Thanks, Kev.
Thanks, Billy.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.